Listen, welcome to this panel. This is a capital panel of capital providers to our industry. And this is your opportunity, and this really was for, we've got a few questions that we put together to kind of get the conversation started. But I want you guys to ask them questions that you may have out there as we go through the program. All I'm going to ask you to do is raise your hand so I can run the mic to you. And then if you have a question in particular for a particular panelist, say so. Otherwise, it'll be for all the panelists, and we'll go through it that way. So without any further ado, I'll let the panel introduce themselves. Jimmy.
My name is Jimmy Rambo with Spartan Financial Partners. I lead our relationship management and business development efforts on the line of credit side. Spartan Financial is a division of American Credit Acceptance. We're a $3 billion automotive finance company. But then Spartan is the commercial division. We provide lines of credit and bulk purchase programs.
Good morning. I'm Jay Cook with Pacific Western Bank, and we're national bank recognized throughout the country, based out of California, state charter bank based out of California. We also provide lines of credit, like the other gentleman up here, to operators, both captive auto, indirect auto, and really any other lines of credit that involve the underlying collateral is consumer oriented, so consumer paper. So a little bit up and down the spectrum across that.
Thank you, Jay. Mr. Wright.
Hi, I'm Paxton Wright. I'm with Primalin Capital Partners. I'm the Chief Operating Officer with our company, and what we do is we provide revolving lines of credit for buy here, pay here, lease here, pay here, and auto finance companies around the country. We also do floor plans. Historically, kind of one of the new things we're rolling out at this year's show is we do floor plans for customers that have a revolving line of credit for their receivables, and we're adding a standalone floor plan product this year.
Good morning. I'm Brad Fisher with Texas Capital Bank out of Dallas. We have been lending to consumer finance companies, buy here, pay here dealers, and auto finance companies for 15 years at Texas Capital, and probably another 10 years before that with a previous company. And we do revolving lines of credits like these guys, and not much different.
All right, great. Thank you. So there's your panel. I know most of them, other than Jimmy, who's new to me, but I've known the rest of them for, I don't even want to tell you how long, but it's been a long time, even with previous companies. But these guys are out there lending to you to grow your buy here, pay here business. So ask them the questions you need to ask. I just want to kind of start off with this one that's really not on here, but it kind of is. I'm out in front of 20 groups and in front of dealers 15, 20 times a year. Most of them have lines of credit or looking for a different lender. And I cannot tell you guys the number of rumors that turn out to be not true. And to give you examples of, hey, First Tennessee's not doing any business anymore. Well, we just did one yesterday. Hey, I don't think Park's in. No, they're not in. Hey, Ameris is taking over Hamilton Bank. Hey, they're going to do business. No, they're not right now. There's a lot of misinformation about what's going on out there. So I would like from each of you to kind of tell us kind of what your niche is and what you're looking for, and are you doing business today with us? Jimmy, we'll start with you.
Yes, we are.
Yes, we are.
We are in business, and we're looking to expand. And I guess kind of our niche, it tends to be kind of, depending on where you're on the cycle, most times it tends to be in the newer part of the cycle as you're starting to grow. And then what we're trying to do is be that kind of advisor and resource to kind of help you, put you in that place where you can grow. And so a lot of that ends up helping you with policies, procedures, making sure you've got the DMS provider, sure, your accountant, and just being a resource. And one thing we enjoy doing too is bringing people to Spartanburg to see how we operate, and provide, send you through our compliance department with our servicing department, and just be a resource for borrowers.
Very good. Jeff?
Sure. Well, that's a great handoff, because where we fit in with from a bank or traditional bank lending product is we typically come in where you have gone through a growth phase. You've established your policies, your procedures, your systems. They're adequate. They're traceable. They're verifiable. You've got profitability that you've built, your sweat equity that you've built into it. Call it 2, 3, maybe 4 years along those lines. So you've got a little bit of experience. You've got a well-established receivable base that's got good performance characteristics that we can trace and monitor. And then we come in at often a different price point, but also a different advance rate point behind Spartan or even PrimaLend or some of the others. So it's kind of a nice partnership, if you will, that can happen and that has happened in the past. And so that's kind of where we fit in. And in terms of just credit lines, we really kind of look for kind of on the low end, roughly anything that would fund roughly $5 million to $8 million or better day one. So that keep in mind that's in terms of receivables and depending on advance rate, how high you'd have to be. And then we have lines that go up generally to $50 million. We'll go above $50 million once you've grown, but usually you've got a little bit of a history with us. So.
Well, to kind of touch on what Jay's saying, I mean, we talk about traditional bank financing for buy here, pay here dealers and independent, finance companies as kind of the holy grail, right? Everybody in the room wants to get to bank financing. For us at PrimaLend Capital, it's interesting. We're definitely in the business. We're looking to grow the business. We've got dealers, all across the country. We're supporting over 120 rooftops currently. And to put that in perspective, when you have an entire portfolio full of, customers that can't wait not to be your customer, because what we want to do is be able to graduate them to the guys on my right and left. And so our strategy is really as a stepping stone lender is to help you put together all of those processes and procedures, financial statements, understanding your business and the metrics that are going to be necessary to basically build the profitability, build some equity in your company, and help you graduate to the next level, which is a cheaper cost of funds.
To answer your question specifically, we're definitely in the business. If we weren't, we've wasted a lot of time and money being here. But so we are definitely looking for new relationships. We've been actively involved doing new deals for 15 years at the bank. Never once during any of that time have we ever pulled back and pulled away from the industry or not looked at funding new deals. So I think a pretty consistent capital provider to the industry for 15 years. We're looking really for companies that kind of have a proven track record, 3 to 5 years in business, some profitability, some receivables history that we can audit to and that we can look back and verify and kind of run through ratios and make sure that we're lending the right advance rates against the collateral. And we've got a dedicated team at the bank of 25 people or so, our own auditors, our own in-house staff, our own account executives that help us monitor deals. So when you do business with a bank like us, we've got a full team that's there rather than just one or two bankers, which a lot of times people run into problems at their current bank because they've got a relationship with their current banker but not an entire team of people. So one of the benefits I think we bring.
Thank you. Any questions so far from the audience? I'm going to get you figuring out what you really want to ask here. I think one of the questions I have is, while we're going to do this one, is have you guys tightened up? Have you changed your credit standards of late? And anybody want to take that? Because if you don't say no, we're just doing business as usual. Has anybody changed what they're looking for?
I just want to write down the bank name.
Pacific Western Bank. Pacific Western Bank.
We got that one.
You got that? Yeah. We used to be Capital. Well, we're Capital Source. We're Capital Source was a division of Pacific Western Bank, and we just dropped the name, and we've been in business a while. So.
Yeah. Anything? Have you guys changed anything out there? Are you more concerned?
I would say we haven't really changed our credit perspectives ever. I think we've basically looked for good management, good collateral, profitability. Our advance rates have stayed the same in terms of how we look at advance rates and how we monitor performance of the portfolio. I think we've had a pretty consistent 15-year approach to the business. I think things have definitely gotten tougher for the dealer over the last several years. So there are maybe some things there that present some challenges, but from our credit perspectives, I don't think they've really changed.
I wouldn't say that our credit, really has changed. What has changed is, to Chuck's point earlier, there's a lot of different banks and institutions that come in and out of the space, and so as that cycle happens for PrimaLend, I think we benefit from that. We see customers that maybe have typically had traditional bank financing for some long period of time. Maybe they've been with a traditional bank for 5-10 years, but as a result of the bank either exiting the space or a change in their underwriting or just tightening in covenants, whatever it may be, has created opportunities for our company to really underwrite a better customer than what we typically see. So I would say over the last 12 to 18 months, we've certainly seen a better, higher quality dealer that has come to us than maybe what we had seen historically.
No, absolutely. And I would just add to kind of what both these guys have said too. Our credit standards really have not changed. Our credit quality, the way we look at credit and evaluate it. And I think the one thing I would add is, particularly with advance rates, that's always a hot topic. And our approach to that in setting those advance rates are not meant to be, one, they're not to be punitive. Two, they're meant to be consistent. And they're meant to thirdly, they're meant to complement your business. And they're meant to complement your growth, your strategies, your projections of where you want to take the company. I don't know that any of us up here would tell you we would force you to borrow more than you need. I mean, that's not the goal of a partnership with a bank or with, PrimaLend or Spartan and everything. It's a growth opportunity. It's a growth vehicle. But it's also a measured growth vehicle. And so I think what we look for is and I think when you get kind of to the longer term bank relationships, that's what we look for is a partnership to help walk with you. And as kind of like Brad mentioned, staff of people that help monitor and help walk along with you, point out things, not tell you what to do, where to go, let you follow your dream, but react to and respond to what you're doing, and essentially give you a third set of eyes. But in terms of credit standards, we haven't changed. We still look at the same fundamentals, and that's pretty standard. Even though you guys have gone through and are still going through and have gone through the years, the better part of 15 years that we've been doing this as well, you've got ups and downs, and so somebody that walks along with you, and that's I think what each one of these guys would say the same thing.
Yeah, I'd say our underwriting characteristics and everything have stayed consistent in the standards. I mean, we kind of look at 4 C's with it. First being collateral, and then the cash flow of that collateral, then to a certain extent the commercial risk, the balance sheet financials. But then the other 2 are the character of the principals, and then compliance now. So those are the 4 things that we look at, and all those have stayed consistent throughout the time.
Yes, I got a question specifically for the 2 first bank, Texas Data Bank, Texas Capital. My name is Luis. I'm from Guatemala in Chicago. We base 2 locations. What you will offer for a credit line out of state for people who got floor plan and says, you know what, I want to be done with a floor plan and I want to start having just a credit line, because most of the banks we know, they don't do dealerships. What Texas will do for people out of state? And for you, for the floor plan, what can people say, I want to go to your new floor plan, and what you will do different than other floor plans so we can come to you? 2 different questions.
So the answer to your out-of-state question is, even though we're a Texas-based bank, we're still a national bank, and we do lend nationwide. So we've got dealers all across the country now that we lend to. We don't do floor plans ourselves. Some of our dealers do have floor plans, and we enter credit agreements with those floor plan dealers that specifically says that the inventory is theirs, the receivables are ours, and it works that out. So you're free to continue with any of the independent floor plan dealers or that you have now or that you use, and we could still do a receivables line on top of that.
We started out in the floor plan business really as a courtesy to the customers we have that had a receivables line of credit with us. It was really an ease of process that we wanted to put in place for the dealer. You have a standalone floor plan with a third-party vendor. You would sell a receivable. Well, as Primalend, we would know that the receivable has been sold. We're providing you credit, right? We're going to give you a loan against that receivable. And so it just made sense for us to start providing floor plans where you go to the auction, you buy the car, the title would come to Primalend, you sell the car, we're already in possession of the title, we send it back to you, give you in-transit credit. So it gives the dealer the ability, rather than to have some of that cash pressure that they would have on a floor plan, of paying that back within some period of time, right? Sometimes as dealers you're going to float and play the game with the floor plan lender, but with us we were able to eliminate that process because we would say, listen, we're in control of it. The title would come directly to us from the auction or from the wholesaler. We provide it back to you. You file it with the state and then send it back to us, right? And so from a cash management position, it was a big benefit to our dealers. We then took that and said, well, as a result of this, we've actually had a lot of questions about our floor plan product because dealers talk to other dealers, and so we started offering a standalone floor plan product just this year, which, to speak to that specifically, just come by the booth and we'll have a conversation. Thank you.
Do you guys do business in Hawaii?
No.
Oh, we would love to do business in Hawaii. We haven't. We don't have any Hawaii dealers, but
Do you guys have any vendors in Hawaii?
I don't know of any reason why we wouldn't.
If he can't do it, we'll do it. Okay.
They don't. All of it.
My
This
biz dev
question
guys
is
in the
primarily
audience
for
just told me
Texas
that now we do Hawaii.
This is primarily for Texas Capital Bank. Do you guys do loans or lines? And how small do you guys offer either these loans or lines? And does it help if you already have a floor plan and you want to switch it over to join with you guys?
Okay. So he's asking Brad, do you do lines of credit and loans? And I think he asked kind of what you talked about earlier, floor plans, or will you help them get out of their floor plan and turn it into a receivables-based loan?
Okay. Yeah, we do lines of credit based on the receivables, and we do it on receivables. We're not currently doing it on leases, but receivables only, and it's a revolving line of credit, so it's not a term loan. So as your receivables go up or down, your availability goes up or down based on the amount of your receivables. And floor plans for us, again, we don't do floor plans. We leave that. We find that from a bank perspective, it'd be pretty time intensive and very hard to monitor as much as the cars move in and out, and that the local floor plan dealers are better equipped to monitor that flow of cars and make sure that you're not out of trust on cars. It's just hard for us to monitor that, especially on a nationwide basis. We just don't have the staff really to do that.
Do any of you, with a startup business, engage in benchmarking to be able to get into your approval process a little easier?
Does that to anybody in particular, Charles?
Well, Texas Bank in particular, probably. Texas Bank in particular, probably.
So are you asking if they would do a startup?
If you're in a startup and you want to get with a bank in order to get through your approval process, that you are familiar with a company, that you would do benchmarking with them for a certain time frame and then engage into the business if they can meet your benchmarks.
Okay, I apologize. We're getting some background noise from back here, so I'm having a hard time. But I think if your question is about if you have a startup business, would we finance a startup business? Or
I think what he's asking is, if you said, like, our minimum criteria are 3 to 5 years in business, would you have some sort of relationship with us to give us timelines and guidelines, that things that we need to have kind of checking off and benchmarking until we get to that point?
Yes, I would say there's been several times where we have, on a quarterly basis or semi-annual basis, talked to people, and they've sent us financial statements and updates on where they are on their progress in terms of earnings or in terms of receivables, and we've monitored some things along the way, and then we've gotten to a point where we can finance them when they are kind of at our minimum thresholds or time in business. So we absolutely have developed relationships. There's been several people that we've talked to here year after year at our booth, and then kept up with throughout the year, and eventually been able to finance those people.
All right. Additional questions out here? Oh.
Okay, quick question. So you guys said you fund finance companies. If the finance company's been around for a while but the dealership is new, would that be okay?
So that's if you got a history with the finance company but not with the dealership?
Yeah, like right now I have both for a long time, but I'm looking to just start a new dealership and keep the same finance company. So would that be an issue, or would you still go based on the fact that the finance company's been open for a long time?
Jimmy, you start there.
It depends on how much you look to fund day one. We're typically want to fund a minimum of $1 million. So if you've had that finance company around and you've got a receivables base that's going to be roughly $1.5 million to $2 million, then and that's kind of established on its own, then we're less concerned about the new startup side of the dealership. But if you've got that receivables base and it's got some history that we can track.
Okay, you guys are Spartan, right?
Right, Spartan Financial.
And Jay?
Sure, yeah, absolutely. And this is not an infomercial. I know Sessions. We're here to help you guys. But again, at that level and that size and the life cycle that you're talking about, like these two guys, I mean, they've got good programs that help you get started and get established. I guess my question for you is, you said you've got a finance company, but typically you have a dealership first that generates, and then you have a finance company. But you're talking about expanding.
I'm looking to do like a new dealership, like a new company for the dealership, but keep the finance company.
Okay.
Mainly for this reason. So
okay, but underlying that existing finance company, I'm not sure whether to start dancing or what. Underneath your existing finance company, do you already have dealerships?
Just the one right now.
Oh, just the one. Okay, so you want to do a totally separate finance company?
No, I want to do a totally separate dealership.
Okay, you want to add dealerships? Yeah. Okay. Yeah. Yeah. Go ahead.
So for us, I mean, the number of locations that you have, right, whether it's one location or 8 locations, the primary borrower is going to be the finance company that holds the receivables, right? So our borrower would be the finance company, and then the car dealerships themselves would be guarantors of the loan.
Okay.
Right. So if you're adding additional locations and you're growing and expanding, then the finance company is going to be purchasing those receivables from all the dealerships and actually originating those loans. Exactly. And so our borrower is still just the standalone finance company.
Okay. Perfect.
Right.
Perfect.
I think that's the same for us. We're looking for our borrower to have kind of years in business. So if you've got a finance company that's already existing and you're just adding new locations or new dealerships, that's fine. That's different than just being a startup finance company and dealership.
Exactly. And then I was going to ask you about just like interest rates on if you guys how that ranges. Nice. Sweet.
Yes, we charge interest. You're asking what interest rates?
Yeah, just what kind of interest rate range you guys would be able to...
Obviously, there's a lot that goes into that. It depends, right? I mean, that's always the answer. Generally, it's going to be prime to prime plus 3, depending on how leveraged you are, how long in business you've been, how profitable you are. I mean, the more you don't need our money, the cheaper it's going to be.
Okay, perfect.
And for PrimaLend, we're going to be at least twice as expensive as the banks. I mean, typically you're going to be just from an interest rate perspective, about 13.5 plus LIBOR is for a new company that we're bringing into a line of credit. That's a pretty standard pricing for us. And as the relationship develops and grows, there's opportunities there.
And I would say the same thing as Brad said on the thing. Where the bank will have the same typically type bank pricing structure and everything. And again, it's all associated with risk. If they're a startup, like Paxton is saying, you're going to have a little higher interest rate, obviously, or versus once you've got established, operations and so forth, and then you kind of move to more of the bank pricing and everything. But there's a lot that goes into it, like Brad said.
You guys are still over 10% for the most part, usually. Will be over 10%?
No,
over 10% usually.
Not banks. Below 10%.
Oh, so you guys would be okay.
Yeah.
So you guys are closer to the Texas bank.
Bank. Yeah, we should have the banks set together, I guess.
Okay.
2 and 4, 1 and 3, and 2 and 4 are most alike. How about that?
Yeah.
Okay, Jim.
Correct. Ours tends to be similar to Prime Lens. It tends to be it's a LIBOR 12 usually, but that depends. Some factors going in there, but it tends to be around LIBOR 12.
Okay, and then my other question is, we do lease here, pay here, so is that like an issue, or is that?
I believe of the panelists that, Jimmy, are you doing lease here, pay here?
We are not.
Okay, I think we're the only option for lease here, pay here that's on the panel. There's also another company that is in the exhibit hall there that's actually called Lease Here, Pay Here, and they also provide revolving lines of credit for lease here, pay here dealers.
But the bank guys, you guys won't work with that?
Can do.
Even though there's like a ton of cash flow and stuff like that?
Yeah, no, we've done it before in the past. We don't currently lend a lease here, pay here.
Okay. Is there like a certain reason for that, or?
Our biggest issue it's basically the same financing contract with a bullet at the end, right? But our biggest issue with it is that there's not really a secondary market for the leases like there are receivables. So if a dealer does get in trouble, if he can't refinance, there's only two ways that a dealer could pay us back, and that's collect out the portfolio or sell the portfolio. And so you're basically taking away one of those two alternatives if you can't go sell your leases. And right now there's 100 different companies that'll buy receivables, and to my knowledge, there's no company that will buy leases over about $1 million of portfolio, which is well below what we're going to do anyway. So that's really the only reason. Otherwise, it's the same financing contract.
Makes sense. Thank you.
Do either or all of you provide fixed rate term loans after the line of credit has kind of matured and been drawn down?
Do we provide term loans? We could.
To
we
term loan
typically
at the end. Kind of. I had worked at a bank and we had a product. It was a 3-year takedown with a 7-year term. It was convertible. I was just wondering if, say, we had a relationship where we drew the line of credit to a certain level, and as it plateaus, do you have a fixed rate, term out option?
I think we could do a fixed rate term loan, or we could certainly do take your floating rate and do a swap and fix it that way too, to where you buy a fixed rate and for whatever period of time you want to buy it for. We haven't typically done that. Normally, dealers are kind of ever evolving; they're going up or down, or they want the flexibility of the revolving just because of seasonality issues. So we haven't typically done that, but I think we could.
I would echo the same thing. Yeah, it seems that the revolver has always been more conducive to your type of business, to the buy here, pay here, or the indirect or the auto business, and then it helps flow with, like Brad said, helps flow more with your operations and all the variables that go into that, day in and day out, month in and month out, if you will. Where we've done them before, but not initially as the initial. It's usually on the back end, like you're referencing there, but it may be because of other certain circumstances or things like that. Let's say you decided to exit the business, and we needed to work with you to kind of make it, kind of a soft landing and work out down. We've done that in the past, and there are other. We do other facilities with other types of consumer receivables that do have like or basically a revolving period than an amortization period. But we find, I think, consistently that the revolver is most conducive to your type of business in this sector, if you will.
Same for us. We've had a couple of scenarios, and those are typically, very specific, unique experiences where, rather it's a workout type of scenario, something like that, where we've provided a term loan option.
So I'm going to ask you. You going to say something, Jimmy? Sorry.
Yeah, we're the same. I mean, we do not traditionally provide term loans. We have amortized portfolios out in different unique scenarios, but as far as providing term loans, no.
So we're talking about rates and talking about what you do. I need your crystal ball for a second here, guys, because we have this discussion every meeting I go to, and where are rates going? In the next couple of years, you guys need it, and you can't be wrong, and this is being recorded, so so what do you think? Because I mean, everyone's very conscious of rates, obviously, these days.
I think if I knew where interest rates were going, I probably would not be sitting right here right now. One important piece of that, though, is we're more or less at a historic low with rates, and as rates, if they do start to increase, understanding what impact that has on your business, and then as that interest expense increases, what operating expenses do you have to kind of reduce to offset that? That's kind of the biggest thing how we view interest rates right now.
Yeah, I would echo the same thing. If somebody's got that crystal ball, I'm in. Let me know. No, I think the same thing. It was funny. I was at an auto conference early in the year in January, and there was a panelist that was an analyst, and they asked him where rates were going when the next recession was, and he said, "Oh yeah, the next recession is going to happen on June 20th, 2020 at 12:30 p.m." And we're like, that's pretty specific. Yeah, I think so. Take that for what you want, and that would indicate where rates are going if you believe that, if you would like to believe that. I think, it's like everything else. I don't know that any of us would venture to say where we think they're going. I think they're stable right now at the moment. I think you've seen drops in LIBOR a little bit, and they continue to kind of migrate down. Do we see any large increases at the moment? I don't foresee any, but I don't know that means, it's not 5 o'clock yet today either, so the day's still long.
Well, Primaland obviously has no crystal ball, and I certainly don't. But what I'll tell you is it is something that within our organization we talk a lot about, and it's something that we've been working on for the last couple of years, kind of developing a plan. One of the things we recognize is, the interest spread between what you're charging the consumer and what you're paying for your debt is variable, right? If your loan is with Primaland and it's tied to LIBOR and LIBOR is increasing, our warehouse facilities that we have are also tied to LIBOR, right? So Primaland's paying more for the money that they're borrowing. You're paying more money for the money that you're borrowing. But as a dealer, your ability to actually pass that on to the consumer in most cases is very limited, if even an option to you. So we recognize that compression is there and that's starting to happen. And so we've been doing a number of things within our business to try to alleviate that. And a big part of that is our partnership with the banks, helping our dealers actually graduate and get them to a traditional bank financing so that their blended cost of capital is reduced dramatically.
Well, obviously no one knows for sure, but the one thing, the Feds they're concluding their 2-day meeting today. So, maybe by the time you get out of here, they're going to make some announcement. So that's probably what I would listen to if you want to defer that question for a couple of hours and actually hear from the Federal Reserve. They're probably going to tell you where they think rates are going. I think still, though, even based upon that, if you look at what the analysts expect, what the futures rates are, the market is thinking for some reason that the rates are going to go down before they're going to go up. So that's not me saying that. That's just if you look at what the futures rates are and what the analysts are saying. I think everybody expect the Feds not to probably move the rates today, but maybe they'll make some indication that they'll move them in the next time they meet in September or whatever. So that's about the best I can.
So while you're thinking on your next question up here, I would ask you guys, and I know you're all different, in your business model, but I want you to tell me your ideal candidate in 5 key areas or 4 key areas, right? Just like our buy here, pay here dealers, how long on the job, long on the residence, right? Income levels. Give us your 5 key profiles that if I took this dealer to David Fricke, he couldn't say no. So why don't you just kind of give us your key attributes you're looking in a candidate for Spartan, Jimmy?
The first thing we're looking for is, do you have a DMS provider? Is this a reputable one that we've worked with and know? Are you using a buy here, pay here accountant? How many, have you kind of had those conversations? Are you starting to document your policies, procedures? How many vehicles you're selling per month in that portfolio being somewhere? We'd want to see it to begin with, but somewhere between 3 and 5 million.
3 and 5 million. Okay, Jack?
Yeah, as I mentioned earlier, I think at the outset when we were introducing ourselves, I think you've got several different areas that we look at kind of from the bank perspective. And they're not different than I think any of the other banks look at it either. But, obviously you want to have a history and then systems and a provability or a traceability, if you will, to the actual performance of the collateral. And by that I mean, obviously you want a good system in terms of contract the collateral, monitor how you perform collections, be able to give feedback and data towards that so that we can derive and see how your portfolio is performing day in and day out, month in and month out. So it has to be, you want a good operating system, a good foundation in terms of an enterprise with the company. You've established, you've got a proper equity and capitalization in the company so that our advance rate complements and our facility complements your capital to help you to continue to grow. And you want, obviously with that comes an operating entity that's been profitable, preferably profitable. You want that as well, but it's got a good track record. You've got stability and everything, and that helps us to complement you as you move on up the ladder and expand. I think a good plan, a good time horizon, whether that's a 3, 5, 10-year time horizon, is something that helps you keep on track, just so that we can walk along beside you, at the same time. So I think those are kind of the primary ones, and then each one of those we've got tentacles, if you will, or silos that drop down out of that we look at more specifically in terms of individual credit metrics, whether that's collateral metrics or performance, statistics, and that helps us set a lot of the parameters that we can offer you guys.
We're obviously all very, very similar in that aspect. I think just a different way to answer the question is actually to talk about what the process looks like if you're looking for a loan. And so at the end of the day, we're an asset-based lender, right? We're going to look at the underlying collateral and to really try to understand what kind of car are you buying? What's the cost of the reconditioning on the vehicles that you're putting on the street? What is your markup? And then we look at the back end of that. Once we understand what you're originating and what that looks like, we're going to say, well, how is it performing? What are your delinquencies? What are your charge-offs? What kind of recovery dollars are you getting? How are you recording those recovery dollars? Is it, are we using a book value? Is it something that you're just mythically creating yourself? There's a lot of other of ways to do that. And then we're gonna look at loss to liquidation ratios and CRRs and all of these things. But at the end of the day, what we're going to do is be transparent and share that information back with you as a dealer. We're going to say, listen, here's how we view your business through our lens. These are the things that are important to us. These are the reasons that we look at these metrics. And that's just on the collateral side. Then secondarily to that, we're looking at the financials, obviously, of the business, but also as a dealer, I think it's important to understand we're going to look at you as an individual, right? It's a lot about the relationship. We're very focused on the relationship. We've had a lot of deals where, maybe the metrics and the math and everything adds up and it looks like a deal that we should do, but if we can't get comfortable with the owner and the people that are running the business, then that's not going to be a deal for PrimaLend. So it's very much a relationship business, very, very similar to what your business is. You may have somebody with the right pay stub and the right down payment, but if you're just not comfortable with the underlying consumer, that's probably not a deal you're going to let roll. And for PrimaLend, it's very similar.
I mean, there's obviously a lot of things that go into it, but if you're talking about kind of top 5 key things to focus on, we're looking for somebody that has a track record that's been in business 3, 4, 5 years, somebody that's been profitable over that time period. We're not really about turnaround stories where we lost a bunch of money last year, but everything's going to be okay going forward. So we're looking for time in business, profitability, leverage is extremely important. We're going to lend you no more than it cost you to create the receivable. So in other words, if you're buying a car plus your make ready and you've got $5,000 invested in that and you're selling the car for $10,000, we're not going to lend you more than 50 cents. So if you're leveraged 65 cents on your portfolio, we're not going to be able to do that. So that we're trying to lend you back what it costs. So leverage is important. And then other than that, I would say having a DMS system that we can audit to, that can provide historical records of how your portfolio's performed over the last 2 or 3 years, so that we can go back and look and analyze and see how the portfolio's collected out. We're very much first and foremost collateral lenders. Profitability and management and all those things are important, but if there's one that's a little bit more important, it's going to be the collateral and being able to analyze that. So those are the things that I think that we look at. And then, as long as you can have a portfolio of about $10 million where we can lend $4 or $5 million, that's kind of important too. That's kind of our starting point.
Yes. Again, we have a company. What can we offer for a company that it's been 15 years in business and it's got 2 properties paid in full? One property paid in full, one potentially almost paid. If you want to go to you guys to do business, strong business, for having more cash flow, do we have any programs specifically for those companies? And the other question is, and if we have for new companies like 3 years in business, that they're not buy here, pay here, if we have credit lines available to offer it to those dealerships.
So you're asking them if they have working lines of capital secured by real estate. No. Not in this division.
Yeah,
No,
not in this division. Yeah, we
Yeah, they typically don't.
Probably, I mean, the bank does real estate loans, but they would have to just be a real estate loan. We would not structure a revolving line of credit based upon real estate.
That's right. Yeah, that's right. Because we did, again, I think our lines of credit, our programs are set up to cater towards that particular collateral, the auto collateral, if you will. I think Brad said we do the same. We have real estate division that lends against specifically for those purposes, and that's a different model and so forth.
And if I can speak to that, Chuck, for 1 second, what you're suggesting is a big problem that we see in the industry pretty often, right? It's very common, especially for new companies. You have people, maybe they have a high net worth or they come from a different industry with a 401k and a bunch of real estate, and so that's what they do. They go to their traditional banking relationship. Maybe it's a local credit union who gives them $1 million line of credit so that they can use that money to go build a receivables pool. The problem is that nobody's monitoring that receivables pool. They're not. When you have a charge-off, you're probably not paying down your bank. And so we have customers that come to us very often that say, hey, we've got a receivables line, with our bank and so on and so forth. And the reality is what you have is a real estate loan with a local credit union, and you have $1 million worth of receivables and $1 million worth of debt, right? So you're 100% leveraged, and there's really not an opportunity for anybody on this panel to actually to help you with that. So you're far better off by actually building a receivables pool with a lender that is leveraging those receivables to help you grow. Will keep you out of trouble, if you will.
Yeah, I'd add one. The regulations with regard to real estate lending are so tough that, like in the bank, even if we have a customer who comes to us and wants to financing for a new dealership, even if it's been a 10-year customer and we've got a long track record, we're going to have to refer them to our real estate group because there are so many regulations and rules specific to real estate lending that all of the real estate lending in the bank gets done in one area.
Many of our dealers don't own any property.
It's to your advantage if you have equity in your property, right? Because if that property is owned by the business and it helps the equity of your company, then fantastic.
We also had a question back there that kind of, I know the answer for our two bankers is see us in 3 to 5 years and 5 to 10 million. What do you do, Paxton or Jimmy? I've been in business 20 years. I've run a service shop. I'm getting into this business. Where do I go to get it off the ground to this kind of point of, I don't have, a few $1 million just floating around?
Chuck, honestly, we've done, Jimmy, you mind? We've done very few day one startups, okay? We do have, I don't know, Matt, 1 or 2 in our history probably?
And Matt, would you consider that to be buy here, pay here experience or just business experience?
No, it's industry experience.
Yeah, exactly.
I mean, right. So a number of those customers that we brought on had, like you said, 15 years as a finance manager at a store and ran the subprime division and did other things and had relationships and things of that nature. We've looked at those opportunities, but oftentimes we've said, okay, well, let's see you build some equity or put some equity up. We'll match that, and then when you get to the next level, we'll do another match. We've done some customized deals structured that way for people that have a lot of knowledge.
Gotcha.
As a general rule, we do not fund startups. We want to fund $1 million day one. So a lot of times what we're doing, if someone's coming in with that smaller portfolio, is having that conversation to kind of guide them and kind of advise them to get them to that period. So we could fund $1 million day one, because our commitments range from 2 to 20 million, and just having that funding day, that $1 million day one of it.
The other question I had here for you kind of ties to those kind of things without startups is, do you guys see a lot of applications for lines of credit from people who are moving banks, whether they've outgrown their bank or the bank has got out of the business? What is the number one reason you can't get them done? They have loan experience, they have business experience. Is it leverage? What is it?
That's it. That's the biggest reason that they're coming out at a too high of advance rate. And that comes from us doing on the indirect lender side and the buy here, pay here side.
Yep.
Yeah, I would say it's no question leverage is number one, and number two is probably some kind of a profitability issue, or where they've had a hiccup the year before and their existing bank's asking them to leave, and so they're shopping, and we can't do it either.
No, same thing, and that goes back to the point that we were making earlier, is that when you start it's important about your capitalization in the company as well, and that feeds into where your leverage on your receivables. So the exact same thing. Those are the key things that keeps getting it done.
Yeah, we can. So as I mentioned earlier, that we've seen an increase in the applications that we get from exactly that scenario. Maybe slightly higher leverage, maybe less profitable than historically, or where the bank wants to see you. So those are opportunities that we look at all day long.
All right, hey guys. I think the other big issue is going to be, I certainly know that you guys you're going to interview me and see what I know about my business, and probably talk about my projections and where we think the business is going and why I need your money in the first place out there. Do you require audited or certified financial statements as a rule, and what kind of reporting requirements do you have on me on a regular monthly basis?
It depends on the commitment size of what standard of financial statements. I mean, we can go from the smaller commitments compiled, but then typically as we get above 3 million reviewed and above 5 million audited, and that's really not that's really to provide kind of a control for you as well, because as you start building a portfolio of that size, those are extra controls and things you need in place.
Yeah, exact same thing. I mean, at the level of 5 million and above, I mean, by that point, you've got to establish operations and everything. And we typically look for reviewed financials. And then as you grow and the bigger you get, audited financials. There are smaller operators that have either we've been with us and they've shrunk down and everything. We will look at just compiled from that standpoint. But again, that's generally we don't have too many of those from that standpoint. From reporting requirements, again, I think at the minimum you're looking at a minimum each month is a borrowing-based report, the reporting of the receivables, the back, kind of a backup and a trail that backs up that borrowing base, if you will, a download. We'd like to get that as well. And that's important because we run a lot of metrics off of that just from the collateral standpoint. And then, of course, monthly financial statements at a minimum is that. And those can be compiled monthly. Those can be just because they're interim, but on an annual basis, either reviewed or audited is where we typically go look at that.
We've done all levels of the spectrum. I mean, we've started with dealers that have no financial statements, where our guys actually help them build financial statements in the underwriting and kind of business development process. We like to call that a prime and lend light deal. That's maybe a $500,000 million size loan, where we're really taking kind of a mentor type approach to what we're doing. And up through reviewed and audited financials. And a lot of times, Chuck, that's driven by the dealer in the sense of when we have the conversation and as you called it, the interview, it's what are your goals? What do you want to accomplish? And if it's, man, I can't wait to pay prime and lend off at the high interest rates as quick as humanly possible, well, then let's get you some reviewed and audited financial statements, because if you want to do business with these guys, that's what they're going to require. And so if you want to be a prime and lend customer for the next 10 years, then we can do reviewed statements. You don't need audited. And so I think a lot of times it's understanding what the dealer's goals and expectations are. From a reporting perspective, I think everybody on the panel talked about the importance of a DMS. A DMS is really how you communicate, with us as your lender. it's extremely important that the DMS be accurate, that we understand how you're using the DMS, how you're inputting the information, because one of the things that makes us a little different than a bank is we're actually going to do a lot of that heavy lifting for you, right? PrimaLend, we've got a big staff that we're going to have direct access to your DMS. We're going to be downloading the reports. We've got an online portal for borrowing bases and things of that nature. So the DMS is critical as far as the actual amount of reporting that you need to provide to us. It's almost zero. We actually provide most of the reporting to you. We don't have a specific DMS. There's a lot of DMSs that we accept, but we do have an approved vendors list for DMSs.
Yeah, for us, I mean, we would prefer audited financial statements. We don't really, I think we would accept as long as the borrowings are under 10 million, we can still do without audited or reviewed. We kind of start maybe at that point getting reviewed or audited statements. It is important, though. We do like to see the statements combined from the retail company and the finance company. It's fine that you keep them separate for tax reporting and that you have your discount so that you're not paying more taxes from an income tax standpoint. But we do like to see all of the entities combined so that they are consistent with the year ends when you do get audited statements and when the auditors do combine them. So that kind of eliminates the discount from a GAAP perspective and just establishes a bad debt reserve. Which is going to even be more important next year as the gap is, right. But so from a financial statement standpoint, that's kind of very important to us that those are combined and that they can then flow with the year end, whether they're audited or whether they're internal. And as far as reporting, it's the same borrowing base and financial statements.
Thank you. So this question will be for Spartan and PrimaLend. For someone who has a portfolio of about 4.5 million with about 1.1 to 1.2 in debt, what will be the biggest difference? Yeah. So.
Well, Jimmy's a lot better looking, so there's that.
This is what happened. So a few years ago, I was trying to get Spartan, and I was between Hamilton and Spartan. And what happens is Spartan wanted to change my business model, which Hamilton didn't. So I was trying to get Hamilton because of that, and then basically the deal fell through because of now with PrimaLend deal. Sure. So now I'm basically here trying to get some funding.
What I would recommend is that you just stop by both booths and have a conversation with both of us. I mean, the idea of the panel is we want to educate and let everybody know what we do. But as far as specifically some of the differences between the two of us, just swing by the booth.
Fair enough. They're happy about that as well. We got about 5 minutes left here, and I had one that I've just, it's been on my mind a lot. It's have come up in a lot of our groups, and I know the financial crisis back in 08 and 09, and it produced about 3 or 4 years of renaissance, buy here, pay here. The best of the best customers were coming to your stores, and now we've gone through what you hear people talking about. It's been a cycle of subprime, and we've had tougher and tougher times. If you're surviving in 2019, good for you. But I know for a fact it has created some deals that have gone bad for us up on this panel. We've all shared a few, probably more in the last few years than many of the years prior to that. What do you guys see out there where dealers make a mistake and get themselves in trouble with their debt and their line?
I'll start. I think the biggest thing that we've seen when the deals have gone bad is when the dealer has focused more on growth versus profitability and so focused on the number of sales and less on the servicing and the collection end of it. And that growth, they haven't really prepared for it and had that infrastructure in place, so that growth's gotten them in trouble.
Good. Jay?
Yeah, I would echo the exact same thing. I mean, we've talked about this earlier, your capitalization and the relative use of your advance rate. I mean, the one things that we don't want to do is advance you more than you need or more than, and Brad mentioned there, more than your cost in the vehicle for a captive auto operator. So, again, we don't want to advance your profit ahead of time. That's what you leverage the receivables from our line to help build that up over time. We've also seen, I mean, generally what we've seen through the years has been it's more self-inflicted than anything, than it is so much economically driven, because your industry is somewhat resilient in many ways to the ebbs and flows of the economy. Now that's not to say that it doesn't impact you one way or the other, but if you keep a proper facility leveraged, not over leveraged, okay, don't get ahead of your skis, if you will, and keep capital and equity vis-a-vis building it through retained earnings or even other outside capital, equity capital, and have sources to get to that, then that makes it makes a much easier ride, if you will, and when you go through these kind of ups and downs, throughout the times.
I mean, of course, I think what Jimmy said is exactly right. The realities is that as a buy here, pay here, or a lease here, pay here dealer, growth is rarely the problem. If you want to sell more cars, you can just say yes more often. And unfortunately, in your business, you can sell yourself out of business, right? The car, the collateral, it's just a widget. At the end of the day, you're providing financing, and you're a financing company. And I think the dealers who really get that, the dealers who really focus and understand that, understand the metrics of their portfolio, how delinquency affects charge-off, and how charge-off affects your recovery dollars, and how that ultimately affects the amount of money that you put on the street. Well, how many of those dollars are you putting in your pocket? And that's why you hear these terms, collateral recovery rate or collateral recovery ratio, CRR. That's why all these things are so important to us as lenders. For we look at, well, great, you're creating a lot of principal, but how much of that principal are you actually putting back in your pocket? And is that number higher than the cost of creating the principal? And we see a lot of dealers that don't understand those relationships and how those levers work together. So I think that that's, generally speaking, the start of the downfall. The second is, I think, as dealers, especially those who are growing and don't have a financial background, we've seen them tend to confuse cash flow with profitability, right? When you're creating a big portfolio with a lot of cash that's coming in, dealers on occasion can confuse cash flow for profitability. When you look at your balance sheet and see the millions of dollars that are there, if you have a good accountant who helps you understand what a loss reserve is and what that really means in terms of what's real and what's not, then great. But a lot of you don't, and so understanding that relationship is very important.
Yeah, I would say, growing your business is obviously good. That's what everybody wants to do, is grow their business. But I will say, having lent to this business for 25 years, that almost every time we've seen a dealer get in trouble, it's too rapid a growth is what's caused the problem. And it's, as Paxton said, anybody can, you can sell a car, that's easy. It's when you outrun your infrastructure, when you're doubling the size of your underwriters overnight, you're doubling the size of your collection staff overnight, and those guys are all green, and they're not doing it the same way as your other guys, and then the performance starts to fall off, and all of a sudden you've doubled your portfolio overnight. And then to add to that, when that does start happening, I think the other thing that gets a dealer in trouble, or where we've seen issues, is if they're not honest with themselves on where they are. And if they say, well, I'm just going to do some extensions to get out of this problem for a little while. I'm going to do some deferments. I'm going to rewrite this loan. I'm going to do this. And then all of a sudden, you're just deferring the delinquency and deferring the inevitable. But all of that ties back to too rapid a growth. And that's really kind of where the art or the gray area of this comes in, is what's a good growth rate and what's too rapid a growth rate. So,
and I would follow. We're not telling you that something you guys don't know. We too, as banks, live by the same thing. Growth's good, but measured growth is better. And so we too, as regulated institutions, we get the same questions from the regulators and everything. They look at our growth. They look at what we're putting on the books, if you will, vis-a-vis your loans that we're providing and become our assets. So it's exactly right. And again, you guys know the name of the game is collections. Don't let your collections vehicle and your collections aptitude suffer or let down at all.
I think it's worthwhile to beat the advance rate dead horse, in the sense that you go to the auction and dealers wear their advance rate like it's a badge of honor. Like, oh, so and so gave me 65% advance rate, or and it's like my business is so great. Look at all the money they're willing to lend me. The realities are, if you've got a 65-70% advance rate, you're just you're making a paycheck, but there's very little equity in your company. If you didn't make it into yesterday's deleveraging breakout session, I highly recommend that you download the information from that and talk to Chuck. I think for all of us on the panel, we're constantly telling dealers every day that, listen, if you sell 15, 20% of your portfolio and you let somebody come in and cherry pick it, yes, it's worth 70 or maybe 80 cents on the dollar. But if you're actually going to walk away and padlock the door and head down to the Bahamas, your portfolio is worth 45 cents on the dollar, 50 cents on the dollar. It's a very low number. And I think when us as lenders are often spitting that message and sharing that information, it sounds like we have some ulterior motive because ultimately we're the lender that needs to be paid off. But to hear Chuck mentioning that yesterday to a room full of dealers in a different way is exactly right. So really understanding your advance rate and that the goal should be very simple. Borrow every dollar it takes to get you out of the cost of the car, and any penny you borrow over that, you're spending on operational expenses and other things that you're paying interest on that you don't need to be paying interest on. So advance rate and increasing that is very rarely the answer. It's usually operational, it's expenses, it's personnel. Those are the things you need to tweak in the business. Don't call your lender and ask for a higher advance rate.
Okay. Hey, listen, thank you to our panelists this morning for all of your individual and specific questions and your needs out there. You see them in the Expo Hall and in their booths out there. Thank you, guys, and we'll see you in the Expo Hall. Thank you very much.